Hello, everyone. My name is Brian Overby. I am the Senior Options Strategist at Options Play, and I'm going to be your host here for about the next hour. Thanks to the first trade educational offering that putting this webinar together to talk a little bit about debit versus credit spreads. I have about a 45-minute PowerPoint that I'm going to put together, and then I'm going to open it up for questions, and we'll try to show off a little bit inside the Options Play software. But important note that the chat box is not available to all of the participants, but the Q&A box is, and I'm happy to take questions along the way. So if you do have a question, click on the little question mark as opposed to the chat box, and I will try to address it. But before we get too far along, we also have to note that any strategies that we're going to use today or any examples using live data is not meant to be a recommendation, and past performance is not a guarantee of future results. So as far as the Options Play platform, we're going to be showing you some real-time quotes, and you need to know that this isn't meant to be a recommendation by doing that trade. Now, on the first trade side of things, it's always important to read the characteristics and risks of standardized options, which is a PDF that you can get through First Trade if you would like, and also you can get they're happy to mail it to you if you need. And with all of that said, once again, no fees, no recommendations are meant to be done from this presentation, and past performance is not a guarantee of future results. Remember, options involve risks, and those risks could include losing your entire premium when you place an options trade. And we're going to talk about a couple of trades where the risk is limited to that and that premium that is paid for that option contract. And hence that is going to be the main topic of this discussion today. We're going to talk about two very popular trades that if you're taking options to the next level, if you're buying put options because you're bearish, if you're buying call options because you're bullish, the next step is to add a leg to your option strategy. So if I am the buyer of a call, I have the right to buy 100 shares of the underlying based off of the strike price, as that would be my buy price, for a limited time period, which is my expiration date. But I get that right. I pay money. I get that right. Today, we're going to add a leg to this, and in particular on the call side, we'll talk a little bit on the put side too. And we're going to sell, and we're going to be selling to bring in premium to offset a little bit of that risk that's involved with buying an option contract. So by selling an option contract, saying, okay, I'll take on an obligation that if the stock goes up to the strike price on the call side of things, that you could call the stock away from me. So I'm going to have the right to buy the stock at a lower price, and I'm going to sell that right or take on an obligation to sell that stock at a higher price, hence reducing the overall risk of my trade compared to just buying the option outright. Now we're going to also look at the put side of things. So if we're talking about, once again, buying a put because you're bearish on the marketplace, you buy that put, you pay a premium. When you buy that put, you have the right to sell 100 shares of the underlying. So buy means sell with puts, and that makes it very hard as far as questions are concerned. As a matter of fact, I've been teaching options for well over 20 years at this point in time, and I still a lot of people struggle just phrasing the question right about puts, because buy means sell means buy. So it's just kind of hard to get that entire question out without saying something backwards, right? So if I'm buying a put option, I would be considered long that option contract. I would pay that premium. I'd have a right to sell. That means I want the market to go down. Now, what I'm going to do is I'm going to buy a put option with a higher strike to start, because we're going to be looking at the long spreads, the debit spreads. Another way to say it is the put vertical spreads. There's many different ways to say it. Probably the most Understandable would be the bear put spread, and we'd be paying a net debit for it. But if I'm buying that option outright, I'm paying a debit. I'm hoping the market goes down, and then I could buy the stock at the lower price and exercise my right and sell at the higher price. In theory, that's the way that would work. Most of the people would buy the option, market would go down, and they would sell. Okay, and just sell that option contract. Now, we buy that option, we're also going to sell something. So we're going to go further down in strike, and we're going to take on an obligation to buy the stock. We got the right to sell. We're going to take on an obligation to buy. We're going to sell off some of this risk by owning that option contract, by selling a lower strike, reducing the overall cost of the trade. Now, that's the first one that we're going to look at, and that's a debit spread. And in the title, we said credit versus debit. But I'm also going to introduce you to some credit spreads. And we'll talk a little bit about, we're right in the heart of earnings season. We have a couple of big companies that are going to be announcing earnings tonight after the close. And one of them is Meta, and another one is Microsoft. And then tomorrow we have Amazon. So well, just interesting timing, because these type of strategies when you have a known catalyst where this way to think about trading options really applies, as opposed to just buying options outright. All right. So with that said, let's get right into it. I'm using a lot of different terms here because there's a lot of different names, but what is a long call vertical spread? Now, the biggest thing about saying that you're doing a long spread is that usually means that you're doing this for a net debit to the account. Now over here, I've drawn some profit and loss graphs. They look fairly similar to, they're kind of blown up, but they look fairly similar to what you would see inside the options play platform. But we have a bull call spread and we have a bear put spread. Now, they're both considered long spreads, right? But if you're doing a long spread with calls, you're paying a net debit and you're bullish. It's an alternative to buying the call option outright. If you're doing a long spread and you're bearish, you're going to use puts. You're going to pay a net debit, and it's an alternative to buying the put outright. So here's what's up with a long call or put vertical spread. You have an upfront cost, just like buying an option outright. That upfront cost is your defined risk. So if I buy a call option, my risk is limited to the premium paid for it. If I buy a call spread, my risk is limited to the premium that I pay for that call spread. You enter the trade for a net debit. You usually want to enter it as one unit, if you will, a 1-by-1 spread if you're doing one contract. And you're going to do it for a limit price. And we'll talk a little bit about that when we get into the options play platform. With a capped loss and limited upside potential. So the upside potential is going to be limited to the difference between the strikes. So if your strike prices are 10 points wide, that's going to be the maximum it could trade for. If they're 5 points wide, that's the maximum you can trade for. So you lower your upfront cost, but you give up some potential upside. And that's always the case in option trading, that if you're doing, it's really just about trade-offs. You want limited risk, well, you're going to have limited upside. That's simple. And that's where the long vertical spread comes in. It's a directional play. You can do it more neutral if you want to. You can set some of these up. And we're going to set one up in Microsoft, I think, today. That's going to be a little bit more neutral trade. And I'll tell you what I mean by neutral. But one of the biggest things, and this is why this is kind of big around earnings, is that you're buying an option contract. And one of the battles with buying an option contract is that you have to battle the time premium that you pay for that call option or for that put option. And each day that goes away, it's kind of like an ice cube melting in the sun, right? It's evaporating that water, and it's getting smaller and smaller every day. That is also true, especially around earnings, in that there's a volatility premium that's in there. That makes up that entire price of that option contract. And so if you're trading around earnings, not only do you have to deal with time decay, implied volatility might be an issue. And we're going to highlight that a little bit, like I said, later on. But now we're going to be neutral-ish. And I always like to use that non-word neutralish as far as volatility is concerned, because we are buying an option contract and we're buying a more expensive option contract than we're selling. In most cases, once again, you can adjust that any way that you want. So in most cases, you're doing that. So that means that you're buying a more expensive option contract. It's probably got more susceptibility to time decay and implied volatility fluctuations than the one that you're selling. Okay, that's simple. Adjustable risk reward, you can decide what your risk reward is. Like I said, if you do 10 points wide, well, that's the maximum. Well, if you do 5 points wide, that would be your maximum upside. But guess what? The 5 point wide potential maximum upside is going to cost less than the 10 point wide one. So you can adjust it. You can use these spreads you can get a lot of flexibility in the way that you're trading your spread. All right. Okay, so let's look at the bull call spread to start with here. So here's the general, I don't know, things you need to know if you're putting together a bull call spread. Once again, you could call this a call debit spread. You could call this a long call spread. But as opposed to buying the stock outright, we're going to probably buy something that's close to where the strike price is at. The stock is trading here. This would be the break even on our profit and loss graph. We're going to buy something right around where the stock is trading, and then we're going to sell something a little bit higher. So we're going to have a decent risk reward profile if we set up the bull call spread in this type of scenario. Buying a strike price that's close to where the stock is at, selling a strike price that is further out of the money. So our max risk will be limited to the net debit paid for the spread, and we'll talk about order entry. And the max reward would be the difference between the strikes minus that net debit paid. Our break even is going to be the long call strike plus the net debit paid. Now, we're not using real numbers here, obviously, but the way that this would work is that this is your strike of your call. You have to pay something for that spread. You take this call strike and say you paid $2 for the spread. You add that to that strike price, and that's where our break even is at. So you get the benefit of leverage in that you didn't have to buy the stock outright, but you need the stock to move by that expiration date to get to a break even price. If you buy the stock and the stock doesn't move at all, right, you're at break even. So that is the trade-off. You don't pay as much, but you do need the stock to move over time, or you can't even get back to break even at that point, right? Then you have limited and known upside, but the good news is you have limited and known loss to the net debit that you paid for the trade. So what really happens here, people will say, well, trading options is a very risky scenario. And to me, it's all about the eye of the beholder, right? If I'm thinking about buying Microsoft, for example, I'll stay with that example because they're announcing earnings tonight. It's a very expensive underlying, over $500. And if I'm looking at Microsoft on that trade, I'm sorry, and I'm looking at doing that trade, well, then in that instance, I could buy 100 shares of Microsoft, or, oops, one second here. What did I just click on? There it goes. Or I can go out and do a bull call spread. And if I do just one bull call spread, well, then I'm actually using options to reduce my risk overall versus buying the stock outright. Now I have limited and known upside. So the amount of leverage is what you're really thinking about here. How much do I want to leverage my account if I'm trading, especially around an earnings report or something with that risk catalyst that's involved. So if I take all the money that I would to buy that 100 shares of Microsoft at over $500, then now I'm using options as a leverage tool, and then they become extremely risky. So in the options play platform, when we were using speculative trades, we always talk about using the 2% rule. You're going to take 2% of the capital that you would have put either in the stock, or you could just look at your overall capital, and that's how much I want to risk on the trade, especially on a risky trade like something around earnings. So that's the general rule. It's all about how you approach that leverage situation. So now, if I go to the next slide, we're going to look at a bear put vertical spread. So this is an alternative to being short stock. So if you're bearish around earnings, it's very hard to short stock, and you need a margin account. You cannot do it in a retirement account, where, by the way, you can do bear put spreads and bull call spreads in retirement accounts if you have the approval to do so. So you need to get that approval from First Trade and make sure that you have the options trading level and approval to do it. But if it's a defined risk trade, that is a trade that is feasible that you can do inside the options, inside the First Trade retirement accounts. Okay, so max risk is limited to the net debit paid. Max reward, the difference between the strikes minus the net debit paid. Now the break even changes up a little bit because you got to say you're at the long put strike minus the net debit paid, right? So here's where the stock is at. If we bought that strike, we're buying somewhere right around here. You pay that net debit, you need the stock to go down to that level to get to that break even point on the trade. Okay, so now if you have any questions, because we did go through that fairly quick as far as long call spreads and long put spreads, if you do, please do put them in the Q&A box and I'll try to address them. Okay, so now 3 simple rules for debit spreads, and I'm going to go through the rules on credit spreads too. But if I'm doing a debit spread, I usually want to get my risk reward working for me. So for example, if I pay $2 for the debit spread, I would prefer to be able to make $6 on the entire trade, right? So I'm making triple what I put the trade on. Now that's very hard to pull off. You got to usually be in volatile stocks, but that's a nice risk versus reward on the upside. Now, if you can pay $2 and have the potential to make $4 on the trade, that's not a bad trade either. And the options play software will kind of help you with that. So the rules are put together with that type of thought in mind, that if I do put on a long spread or a debit spread, I want to exit if I'm between 75 and 100% of the max gain. So if I get over 75%, I really want to think about getting out of the trade. And that would depend on, where you're at during the day, what you might be seeing in the chart. But when I get here, I don't want to give this up. I don't want to try to get to 100% and lose that 75% gain. So somewhere, my goal usually with long spreads is if I get to 80%, it's very hard for me to not take that profit and move on to the next trade. But on the downside, if I'm down 50%, so we used our $2 example, if I put on this long spread for $2, I'm going to take it off if it's at $1. And I'm going to manage my risk that way. Now, this is our general rules. And inside the platform, if you have trades in the paper trading app, you will get these rules are built into the platform. So if you're down 50% on a long spread, it will say stop loss and think about if you want to exit the trade. Now, I don't mind if you kind of stick to rule 1, that you could also lose in rule 2. It's all about the risk reward setup. So I don't mind letting this run, but you want to be consistent. So in other words, I pay $2 for a spread. I'm okay with losing that $2 if I can set it up so that I can make $4, and the times that I'm wrong, I lose 2, and the times that I'm right, I make 4, and I just kind of put these trades on and I let them work. So just always be cognizant of your risk reward. This setup is fine, and if I'm buying expensive spreads, and let's say I'm not paying $2 for it, say I'm paying $4, and trying to sell it for $12, right? That's a little bit different scenario. And I might think about this 50% loss a little bit more. But here's the thing, and I'm getting a little bit long in the tooth here, in that if I'm going to do these rules, I just want to be consistent with it. I want to be consistent with, if I'm going to be down 50%, I get out. That simple. You're going to get out of a lot more trades, and some of them are going to bite you, and I mean, where they're going to come roaring back, and you say, "Why did I get out of it?" Bottom line is that you did, and you should stop getting quotes on it, because all you're doing is agonizing yourself. Move on to the next trade, and you're done. Now, if rule 1 or rule 2 doesn't work out, I also agree with flexibility on rule number 3. If we put these on, a lot of times inside the options play platform, the default is a 30-day spread, looking at decent risk reward based off of that 30-day period. And you can adjust it if you would like. But if you're doing that and half the days go away, we're just going to say 15 DTE. We're not going to say half. We're going to say that if that's my general rule, that I'm putting on something between 30 and 40 days out, when I get to day 15, if nothing's happened and I'm at break even, or I'm down a little bit or up a little bit, at the 15-day mark, I'm just going to get out. I'm just going to sell it. I'm going to move on. I don't want to deal with that last 15 days of time decay. We didn't hit the max gain. We didn't hit the max loss. It's just time to move on to the trade. It did not pan out by doing the trade. So you can make that 10 days if you want. Don't mind that. But I want you to come up with these rules. We can stick with the rules that are set up inside the options play platform if you want, or you can adjust them a little bit. But once you find your adjustment, biggest thing is that you have a plan and then you trade your plan. And that's been said many times in the options trading world. Okay, any questions so far? No, not so far. So this is the debit spread. I am doing debit spreads. Like, for example, we're going to look at a very short-term debit spread in Microsoft because they're announcing earnings. It's the main reason why. And I'm going to use the platform to kind of look at it. We can look at a meta trade. Amazon's also announcing on Thursday. This is where I like debit spreads, where I have a better upside than downside. And I'm going to put the trade on. The catalyst is going to be big. The stock will probably make a fairly strong move, and you'll know in a hurry if your trade is working for you or going against you. And if that's the scenario, I like to have more upside than the downside. So I'm going to go back to the $2 spread. Paid $2 for it. I want to be able to make 4. And if I put this on and the catalyst is right and I get the direction right, then I get rewarded for it. And I have my risk managed in that way. Paul says, wouldn't this be safer to do after the earnings release? And yes, Paul, it's Paula. I apologize. Paula, yes, without a doubt, that is true. And that's a great question. But let's put it this way. After the earnings release, I would be also more willing to just buy an option outright. So yes, I would be happy to do the trade after the earnings release and still do a bull call spread or a bear put spread. But if I'm doing it around earnings, then I definitely want to do it. Right? I definitely want to do one of these spreads as opposed to buying an option outright. And the earnings is the one time that you can say that I'm going to lean towards spreads as opposed to buying options outright, without a doubt, because of everything that's involved in that earnings report and how it affects the options prices. So just a little bit of a to address that a little bit, if you think of options, what they were first intended to be, something that would help protect an asset. And that's where options first came from, was the need to protect something. And because of that, they're priced a lot like insurance. Like you hear option contracts, the price of an option is referred to, once again, right here, the premium paid. And just like when you pay for your car insurance, you say you're paying your insurance premium. Well, bottom line is, if you are driving a car in a scarier part of the world uh, than than um, than a non-scary part, right? You pay up for that. If there is a big event that's going to happen, if there is a storm that is coming, your homeowner insurance is it's going to be very hard to get homeowners insurance ahead of a hurricane. Well, in the stock world, that hurricane would be earnings, right? And so you're paying up for options. And because of that, and that implied volatility and the volatility that is implied from the earnings, the prices of the option contracts become much trickier to trade, especially if you're trying to buy them outright. Thank you for your question, Paul. Here we go. So, what I've been talking about, and this is something that's misquoted, so I like to try to address this all the time. And because I was always confused about this, honestly, until I started looking into it a while back. But um, the reward risk ratio is almost always quoted as the risk reward ratio. So in other words, it's backwards. So if you think of if you're just doing simple math, if you say risk reward, that means that the risk is on top, and it's divided by the reward. And I don't know if it's just easier to say, but most of the time they say risk reward ratio, and then they calculate it as a reward risk ratio. But this is really important to me. If I'm continually setting up spreads, especially if I'm a speculative trader and I'm trading around earnings a lot, I want to make sure that I got a decent risk reward ratio or reward risk ratio every single time that I'm putting on the trade. And that is going to affect the strikes that I'm buying and selling. So a widely used and misquoted metric, okay, reward risk ratio is the max profit divided by the max loss. Risk reward ratio is the max lost divided by the max profit. But for example here, oops, I didn't mean to zoom. If we buy the 30 strike call and sell the 35 strike call, we do this for a net debit of 150. That means our max profit is the width between the strikes, which is $5, minus that net debit paid. The net debit means that we know we bought one option and we sold one option and we executed it for a net debit to the account is 150. So our reward, it's so hard to say over and over again. The reward risk ratio would then be the max profit, 350, divided by 150, or 2.3 to 1. Now, this is how you hear it quoted all the time, but also a lot of times you hear it stated as risk reward. But here's the way to think of it. You're hoping to make $2.30 for every $1 that you have at risk. And that's the way I always want this to be, at least 1 to 2. If I can get it closer to 1 to 3, that's awesome. But I don't want to do 1 to 1.5, right? If I am speculating around earnings over and over again, where I have the potential to hit the max loss just because it did not meet the numbers, right? I want to get this risk reward ratio in my favor. And it's quite simple. You just, put it in the calculator, look at your max loss and max profit. Very simple to calculate those things and try to come up with that number. And we want it over 2, and you would like it towards 3. So you might say, I'm not going to do it if it's 2.5. This one might not meet your criteria. But if I'm doing these trades over and over again, that's always going to be my goal. And you'll notice inside the Options Play platform, they will This number is actually used a lot in the calculations, and that you see that this one has a rating of 100 for this put debit spread. And if then you look at a next one on a different stock and it'll say, okay, it's a similar setup trade, but that's got a rating of 110. And a lot of times that rating is based off of that risk reward or reward risk ratio, however you want to say that. Okay. So uh, now let's get into the short vertical spreads here. And we're going to have to close this up fairly quickly. I'm running out of time. I got a little long-winded on the debit spreads. But now on the short spreads, a little bit trickier, a little bit more advanced. But one of the things that the at options play that we'd like to teach is if you're doing this, a lot of people like to say, oh, I'm selling option premium. I want to make sure that the stock never reaches the strike. So let's go as far out as we possibly can. In other words, I have a very high probability that it won't reach it, but that comes at a cost. You don't receive as much premium as possible. So if you are bullish on an underlying, and you can be neutral to bullish, but if you are bullish on an underlying, if we can get a decent risk reward ratio or reward to risk ratio on a trade, that's how we like to approach our short spreads. In that I'm bullish, time decay is our friend. Let's get a lot of time decay. Let's sell it for a decent amount of premium. Stock goes against us, there's a chance that it's going to end up in the money. We'll manage that trade. But that's the way and the approach of the options play platform. So a bull put spread here is, now here's where the big difference is. If you buy stock, you're going to use puts to get bullish. Okay, by the way, you're going to use puts to get bullish. So you sell a put. If you sell a put, you're bullish, right? Because if you buy one, you're bearish. And now this break-even point goes below where the stock is at. So the stock's trading here. We're going to move to your right, and we're going to move down on that zero line. And so by doing this trade, and you bring in a lot of premium, you have a little bit of leeway on the trade if you are incorrect on your forecast before you get down to your break-even point. And that's going to be the same thing on the bear call spread. So can be established with calls or puts, offering limited risk and reward and a higher probability of success than the debit spread. You're neutral to bullish or bearish on the market. A net credit is received up front, but you're going to have a margin requirement in that the width between the strikes will be held out. But the downside risk is typically outweighs the potential of reward. So you have a higher probability of success than a debit spread. So that usually means that you don't have as much upside. Okay, so the same concepts are going to apply on our short vertical spreads inside the options play platform. Well, I kind of went through it pretty well. I'm not going to spend too much time here, but a bull put vertical spread, max reward is the credit. The max risk is the difference between the strikes minus the credit received, and that also helps you figure out where that break-even point is at. Short put strike minus that net credit received, and then if we want to get bearish on the market, then we use calls. So as opposed to getting short, we do a bear call spread. And Paula, even to go back to this is a trade that a lot of people would do after earnings as opposed to before earnings. Right now, if I am bullish around earnings, you can get a lot of premium on those option contracts. But this is just a great example, and I keep bringing up earnings because it's the mindset. If I'm going to take the risk of earnings, I want to get rewarded for it, and I'm going to pull in some premium on this. But if I'm wrong, I get hurt a lot worse than if I'm right and I make money on the trade and I get the forecast correct. Right. So this is a strategy that I'd like to do after the earnings report, more so than the bull call spread. But once again, there's a time and a place for everything. All right. So I actually put this one together, and I put the risk reward in this slide. If you want to grab one, this was from not that long ago, but Home Depot is an interesting underlying to do vertical spreads on. And here's two reasons why. It's fairly liquid. You have some volatility with some predictability. I don't like doing vertical spreads in a stock like Tesla that's in the headlines all the time, right? It's very volatile. It's a very volatile underlying, but the news headlines can offset it at any point in time. In Home Depot, you're going to have to look at consumer sentiment reports. You'll look at maybe the earnings reports, sales reports. There are certain times when Home Depot is going to move, as opposed to just because of a news headline of random information, right? So if I'm looking at this, and once again, I want to emphasize this is not meant to be a recommendation, right? And this is an older numbers, but these are the concepts that we like to use when looking for opportunities. So in this instance, you're going to get a lot of premium because this is an expensive underlying. If we just do one trade, we're going to go out 43 days. And once again, we get down to 20 days, we're going to want to get out of the trade. We got that actually highlighted on the next slide, I think, going through the rules. And we're bringing in some real premium. So our break even on this call vertical spread is if the underlying stock goes with the stock trading right around, where's it trading at? 730? Oh, 366. 366 is where we're at. I'm sorry. 370. A little dyslexic there. 370 and 390. We're selling the 366. So we're fairly close to where the underlying stock is at. You take this and you add $7 to it, and that makes our break even at $377.73. All right, on that trade. So if I'm doing that trade and I'm bringing this in, I get rewarded for the trade. We're not that far out of the money. We're fairly close to it. And that gives us a decent risk reward ratio. And I wrote this both ways. You can look at it as the reward to risk ratio is about 60 cents to 1. This ratio tells you that for every dollar at risk you have on, you're trying to make 60 cents. And I feel like this is just a great way to talk about debit spreads versus credit spreads. And a lot of people will go out and change this down and try to sell this spread for $1 as opposed to the $70. Go way out of the money. You still got a lot of risk because you're wide on your spread, but you're only bringing in a small reward. And here's one of the things that happens when that trade is put on. It's not a horrible trade. You got a high probability, but if the market goes against you, it starts hurting very bad, right? Because you just don't have enough. You just don't have a lot of premium to offset that strong move to the upside. Now, you can invert this once again and say it the way most people quote it, risk reward ratio. It's about 1.6 to 1. And that means that you're risking $1.06 for every dollar that you stand to gain in that scenario. Now, in here, inside the options play platform, it's over 100. And that's mainly because of the risk reward ratio for this trade. And that has a lot to do with the strategies that get the high options play score, the green light, if you will, up over 100 on the trade. It's usually because this ratio of risk to reward isn't bad at all, right? We're bringing in $7.73, and well, or you can look at it this way: $773 with $1,227 worth of risk and a high probability of success because because the stock is trading out of the money. All right. Now, these strategies I like to do after earnings. I'm not saying that I wouldn't do it on earnings. If I got a decent risk reward ratio because of the dynamics of the prices around earnings, I don't mind doing this trade. But in general, this is a trade you like to do after earnings. And in general, if you're looking at doing a trade around earnings, a long call or put spread is a viable alternative to this trade. All right. So here's the rules. Exit with a 50% profit. Now, Oh, 100% of the max gain. I read that wrong, my second rule. But exit the profit with a 50% max gain. Now, in this instance, when we're doing this, most of the time, you're going to have a higher probability of success. If you set them up where you're bringing in a lot of credit, this is a more feasible way to do this trade. Now, we're going to exit 45-day credit spreads based off of the three triggers. Okay, so exit with a max loss of 100% of the max gain. So if I brought in $7 on my Home Depot trade, I'm going to get out if I'm down 14, right? So it's 20-point wide spread. I brought in $7. I'm going to say if I'm down 100% on that trade, the market's got to move hard against me. I don't want to lose more than what I would have made if that option contract expires worthless. And that's the way I'm going to approach. I'm going to have more winners than losers. I'm going to take those winners and I'm not going to let those losers kill me and get that max loss on that trade. And then the last rule is if neither one or two is out, close the full position at half the DTE. If it's 45 days, I like to just say 20 days. You can actually just, instead of saying half, say when I get down to the last 20 days, I want to get out of the trade. Just like we did in the long call spread. I actually was thinking to adjust it. I like where you just say, if I'm starting at 45 days, I'm going to get out at 20 days. If I'm starting at 35 days, I'm going to get out at 15 days. So you choose where your starting point is. The default inside the options trading platform is 45 days. Once again, you can adjust it. You can tweak your settings to try to fit the way that you like to trade them. 45 days takes some patience, right? If you're doing that trade, that's just a real interesting place on the curve when you're doing trades. It's the time decay from a 45-day down to a 20-day gives you some protection if you're wrong because time premium sticks around, but it's still a real nice solid rate of decay. All right, and that's where the 45 days comes from. Just studying exactly how options decay over time. All right, my name is Brian Overby. My X.com profile is at Brian Overby, talking about the options play site, and a little book that I wrote is called The Options Playbook. All right, so now I'm getting a little long-winded. We got a few more minutes. If you have any questions, please put them in the Q&A box, and I will try to address them. And then at this point in time, I am going to stop sharing my screen, and I am going to pull up the Options Play platform. And I was having a little bit of issues with this today, but I'm not really sure why that is, but my charts aren't popping up. But I'm just going to run with it because I just want to focus on a couple of trades. Once again, not meant to be recommendations. We can't do that without knowing your risk tolerance and more about your account. And SFT, let's bring up Microsoft. There, that worked. Good. And I got it to work. So now that issue seems to be resolved. So desktop 1, I am sharing. Everybody seeing my desktop. I am back. Just let me know. Let me look at it this way. All right, that's correct. All right. We're getting a lot of thank you. I appreciate that. Practical tutorials. Can we see how to place the trade in the platform? Yes. Would it be a risk? Would it be riskier? What would be riskier, a wider spread or more contracts? Well, the risk is what the risk is, Paula. You know, if I have $1,000 at risk, I have $1,000 at risk. Now, where the risk kicks in, where the break even is, might be affected by the wider spread, might be affected by the number of contracts. So the break even would apply, to address Paula's question, what would be a riskier, a wider spread or more contracts? But bottom line is the risk is what the risk is. If your risk on your trade is $1,000, no matter how wide the spread is or how many contracts you did, then your risk is that. What does the light bulb mean on the chart? The light bulb means that, so I'll let you know. I'm sure that if you have gone to our seminars before, the chief option strategist is Tony Zhang, and Tony Zhang has put in a few different features. One of the things are overbought and oversold inside the watch lists. These are some new features that are available inside the platform. And part of those features are the little light bulb. And that is based off of momentum, off of a formula that Tony has put together based off of CCI, which is not much different than an RSI. It's just a momentum indicator looking at overbought and oversold conditions in the short term versus the long term is really what it comes from without getting into too much detail. But for example, well, we just saw one in Schwab, as a matter of fact. Schwab was part of our daily play. So I'll bring that up. I think it's still in here. Let's look at Schwab in our daily play, and we got an alert. And that's a bearish alert. So this is a bearish counter trend for the stock. It's near a 52-week high. However, overbought indicators suggest that this might be unstable. And that's all based off of the momentum. And down here is a CCI indicator. And we're adding the long-term versus the short-term. So if we go back to the watch list ideas once again, and you click bullish or bearish, sometimes the trades don't come up. Sometimes they don't. They're doing the calculations. But here in this one on ADP, automatic data processing, what do we have here? This is a bearish trade, and it's showing you the bearish. And it's once again, it's the same scenario. Recently experienced a rally with a longer-term bearish trend that may provide a favorable risk reward for a bearish trade. And so that's where they come from. Now, it's all based off of momentum. It's all technical analysis. So it doesn't have anything to do with the fundamentals in general of the underlying. But, you know, we always want to pay attention to the liquidity. And I don't know. Does that answer your question, I guess, overall? All right, so let's go back in and let's look at Microsoft. Once again, not meant to be recommendations. I can't harp on that enough. So I want to talk about a few trades. All right. So if I'm doing a bullish trade on Microsoft, we see right here, it's recommending it's going to go out about 45 days because it is not going. You see that the earnings is today, PM. After the close, it's saying 0 days to expiration, which means it's happening today, July 30th, after the close. If you trade this, you're going to have a decent risk reward here, right? So the one that is suggested, it's going to go up 51 days, and you, like I said, you can tweak that, but we're going to give a lot of upside on this because it is right around earnings. You're paying $19 for the option. You're receiving $3.50. You have 51 days until expiration. And your risk versus your reward. So if we do the reward to risk calculation, 2,890 divided by 1,610, and I got my little calculator here, is a 1.79 risk reward. So for every dollar that we're putting up, we have the potential to make $1.79. Now, if we tweak this and we modify it, well, actually it's going to go up a little bit because we're working off the midpoint now. And we come down around earnings, I don't want to go out that far. I'm going to look at 16 days, right? And now it's saying a little bit lower score on it. And if we trade this, well, obviously we got to give ourselves a little bit more upside. We got to pull it in just a little bit. A one standard deviation move is right at 545. Let's look at something that is about the expected move away, which should be around a 20 delta. So we'll go 540 and we get back to 100. And let's look at that risk reward trade. Okay, so now got a little bit better scenario, well, close. 1,852 divided by 1,148. That risk reward is 1.61. So the score is a little bit lower on that scenario, We're buying something that is just in the money, but how to like this doesn't necessarily excite me as a risk reward trade because I would like to risk one and or risk $1 to try to make $2 on that trade if I'm going to set that up. So if we want to, we can adjust it again. Modify this. Let's see what happens if we go here. One standard deviation is 4 away, and we're close. I'm not going to keep tweaking, but now we're very close to it. 1,400 would be 2,400 would be a 2-to-1 risk reward ratio on the trades. So if you're doing this type of strategy and you want that type of risk reward ratio, you just tweak this a little bit, and this options play score gives you a hint that you're close to a 2-to-1 situation. Now, on the volatility trade, high implied volatility, if you want to get bullish, now you're going to do the put spread, and we'll modify this. We'll go at the midpoint. We'll bring it all the way down to 16 days. And now we're at 90. We're going to sell the 510 by, yeah, let's bring this one up. I wouldn't want to take that much risk on. Look at 480. All right, 90, so trade this one. All right, so a little bit too much risk reward in the, that's 480. What happened? 490, that's what I wanted. That's 20 points wide. Let's try 500. Let's see where that gives us. 92. So let's look at this trade. So if you were to do a short spread around earnings, we're going to go like, I don't want to go out as much in time, and I'm going to sell the 510, buy the 500. The stock is at 513. And I'm going to bring in a real amount of premium here, right? $3.72. So I'm risking $3. Yeah, this isn't that this is a decent risk reward ratio in that I'm bringing in a real premium. I'm bringing in $372 for every 1-by-1 short spread that I put on, and my risk is going to be $625. So the reward to risk ratio, 372 divided by 628 is 0.59, 0.60. So solid. That is an interesting trade. I almost, in a way, talked myself into the short spread, even though I don't usually want to do a short spread around earnings. Because of the way the volatility skew is, I like this risk-reward ratio on a short put spread a little bit better than the ratios that we're getting on the long call spread side of things. Would you like me to look at a particular stock? Would you like me to look at Amazon? Would you like me to look at Meta? These are a couple of other stocks. Now, as Paula mentioned, you could wait until earnings is done and then come in and look at the Microsoft trade. And then I would want to go out 45 days. The default in the platform was 51, but that's only because of where the expiration dates fall. If you do not have any and you're not putting anything in the Q&A box, I'm going to have to call it a day. We're right at the 1 hour mark almost for our webinar today. But a lot of great questions, a lot of great participants. First Trade always provides a very astute option trading client, and I do always appreciate that. All right, well, let's go back to stop sharing the screen. And I'll just leave it at this scenario that thank you so much for attending today. First Trade, thank you so much for putting this all together and allowing us this opportunity to educate all of your clients on option trading. The more you dive into it, having a plan and trading the plan is real important. Understand when earnings are. Decide if you want to trade around earnings or not, because you can obviously always avoid that earnings. They happen once a quarter. We know when they're going to happen. And if you do want to place trades around earnings, there's always the SPY, right? You can always trade an ETF that tracks an index. And then that also mutes that earnings catalyst on a single underlying stock. All right, that's it. That's it for my end. I see a couple of questions out there, but we were a little bit late. We're at time. My name is Brian Overby. Thank you so much for attending. Follow me on x.com. My handle's at Brian Overby, and we'll be back soon again for another opportunity to educate all the first trade clients. Until then, I always like to say, may all the options that you buy finish in the money, and all the options that you sell finish out. Thanks for tuning in.